Hello everyone, a very good morning. Welcome to Oliveboard, and today we are going to discuss some very important MCQs from our module D of the RBWM paper. This is the RBWM one shot MCQs series, and we have already completed the module A, B, and C. Module D, which is very important from your exam point of view. Here we have the wealth management, importance of wealth management, investment management, tax planning, and other financial services. All of these units are very important, and the MCQs that we are going to discuss today are the most important. So make sure that you like the video, you be here till the end, and answer all of the questions in the live chat. Also, don't forget to subscribe to the channel because these sessions on the YouTube channel are going to be very helpful for your exam preparation. So, let us start with the first question for today. All right. What can be considered as forms of investment? So, first, when we are talking about investment management, we need to understand the meaning of investment. So, consuming more than the current income, depositing money in the bank accounts, purchasing assets like real estate or gold, immediate spending on goods and services. So, when we are talking about wealth management or investment management, what do we understand by investment? Investment basically means we use an equation. Saving is equal to income minus expenditure. The part of our income which is left after all the expenses, that is known as saving. And in economics parlance, savings is equal to investment. All right. So investment will be the part that is saved, right? So once saving is given one individual or institution in the expectation or with the aim of earning more income or capital appreciation, then it becomes investment, right? So consuming less and not immediately spending will lead to investment. So depositing money in the bank accounts and purchasing real estate, gold, or other investment products, that comes under investment. All right. So investment process in which the present consumption is sacrificed for a return in the future. Also, the sacrifice is certain, but getting a return in the future is uncertain. All right, next question. What is the purpose of portfolio appraisal in investment management? To measure and compare the risk and return of the portfolio against the expectations, to guarantee a fixed return on all the portfolio investments, to constantly switch securities to chase market trends, to focus solely on the short term performance. So, first, what is the meaning of portfolio? Portfolio basically means a briefcase. So, a collection of different products and services will refer to an individual's portfolio. If I have a certain income, I am dividing that income into investments or insurance, mutual fund, real estate, gold. This is creating a portfolio. So, allocation of money to assets that are expected to yield income or gains over a period of time. That is portfolio. All right. So, what do we mean by portfolio appraisal? It means to measure and compare the risk and return of the portfolio against the expectations. We are trying to figure out how well the portfolio is created, whether it is going to help us achieve our goals and objectives or not. That is portfolio appraisal. Next question. What are the primary roles of investment banking? Now, the difference between investment management and investment banking is very important. Investment management is basically already an individual has surplus money with them or surplus funds with them, and they want to manage it. They want to earn more returns on it. Investment banking, on the other hand, is a type of service which helps the individuals or corporate clients to raise funds. So they are in a situation of deficit. So to raise funds, mergers and acquisitions, advisory services, this come in investment banking. So what are the primary roles of investment banking? Providing personal banking and retail financial services to individual customers, facilitating mergers and acquisitions for corporations and other entities, underwriting new debt and equity securities for various types of corporations, offering legal advice to companies on contractual matters. So, as we have already discussed, the difference between investment management and investment banking. Investment banking typically covers two key areas: mergers and acquisition, advisory, and underwriting, raising capital through selling stocks or bonds to the investors, example IPO. So the correct answer here is yes, option B, 2 and 3. 2 and 3 is correct. All right. So when we are talking about underwriting, capital raising and underwriting groups, they work between investors and companies that want to raise money or they want to go public via the IPO process. Mergers and acquisitions for both buyers and sellers of the businesses. Sales and trading, equity research and asset management. All right, so these are the services. Next question. What are the different types of underwriting services provided in investment banking? Firm commitment underwriting, where the underwriter assumes full responsibility for the unsold shares. Best efforts underwriting, where the underwriter sells as much as possible without financial responsibility. All or none, where the deal is void if the entire issue isn't sold. And continuous underwriting, where the securities are sold over an extended period. So when we are talking about underwriting basically here the underwriters or the investment banks, they work as intermediaries. They match the needs of the buyers and the sellers. So companies that are raising or they are bringing new shares into the market and the investors who are going to purchase them. So bringing them together is the role of the underwriter, right? So the three types of services or underwriting services are firm commitment, best efforts, all or none. Firm commitment 100%. The entire issue. The underwriter buys the entire issues. Let's say there are 100 shares that have been issued, and out of those 100, only 80 were uh, the underwriter was able to sell only 80. The remaining 20, the underwriter will take full responsibility. So there's full responsibility for any unsold shares. Best efforts as much as possible. So if 80 of the shares were sold, 20 remaining, so the 20 will be returned to the issuer. So the unsold shares responsibility will not be taken by the underwriter. All or none, either all the 100 shares will be sold or nothing. So the deal will be called off and the issuing company will receive nothing. So these are the three types. So the correct answer is A. Next question. In finance parlance, how are asset management and investment banking referred to? So, investment management, wealth management, asset management, these more or less mean the same thing. And they're completely different from investment banking. So, what is the difference? Asset management is known as buy side, and investment banking is sell side. Both are commonly known as buy side. Asset management is sell side, while investment banking is buy side. Both are termed as sell side. Yes, what will be the correct answer here? So, investment banking helps with corporate finance needs, such as raising funds or capital, right? So, it can involve equity research or security research, making buy, sell, and hold recommendations. But the investment banking firms are also known as the market makers. The investment banking firms are known as the market makers, which provide liquidity or connect buyers and sellers to make the market. Thus, the investment banking is the sell side and the asset management is known as the buy side. Because in asset management, the managers help the clients reach their investment goals by managing their money. These investment goals can be a stable income or returns in the future, pension funds, retirement plans, insurance, equities, bonds, commodities. All right, so the asset management will come on the buy side and investment banker will fall on the sell side. Next, now we are talking about the tax planning. If income is earned between 1st April 2021 and 31st March 2022, in which assessment year it will be taxed. So the difference between previous year, or which is also known as the financial year, or we have the assessment year. Assessment year. Previous year is the year in which the income is earned, right? Or previous year, financial year is the year in which the income is earned. Assessment year is the year in which now we will pay taxes on the income. I'll be filing my ITR. Both financial year, assessment year, they start from 1st of April and ends on 31st of March. But assessment year is the period in which the income that was earned during the particular financial year is taxed and assessed. So it will be the year immediately following the financial year, immediately after the financial year. So for the financial year, 1st April 2021 to 31st March 2022, the assessment year will be 2022-23. Similarly, if we are talking about 2025-26, the current year is my assessment year. I will pay taxes that I on the income that I have earned in the financial year 2024-25. And for the income that I'm going to earn in 2025-26, I will pay taxes in the assessment year 2026-27. This is how we differentiate. The concept is very, very important. Previous year and financial year is same. Assessment year is the next year. I hope this is clear. All right. When is the income earned in the previous year taxed? In the same previous year, in the following calendar year, in the assessment year immediately after the previous year, or 2 years after the previous year. This thing we have already seen. Yes. So the income which is earned in the previous year will be taxed in the assessment year immediately after the previous year. All right. So basically a period up to 12 months just preceding the assessment year will be my previous year or financial year. And the income that I earn in my financial year will be taxed and assessed in the next year. That will be my assessment year. Why? Because income cannot be taxed until and unless it has been earned. That is why we file our ITR in the assessment year. All right, so this is the whole concept. Next, what is the basic exemption limit for the super senior citizens aged 80 years above 80 years under the old tax regime? So we have three categories: below 60 years of age, senior citizens above 60 years of age, and super senior citizens above 80 years of age. We have the old tax regime and the new tax regime. Regime basically means the tax slabs. What is a tax slab? The tax slabs different for different categories of taxpayers. The tax rates that keep increasing with the increase in the income of the taxpayer. Exempted limit means income up to this level. If the super senior citizen is earning only this level of income, they will have to pay no taxes. So in the old tax regime, for the super senior citizens, the exemption limit is up to rupees 5 lakhs. If they're earning an income up to rupees 5 lakhs, then they'll have to pay zero taxes. Between 5 lakhs and 10 lakhs, 20%, and above 10 lakhs, 30%. This is the old tax regime. Additional health and education cess and surcharge will be applicable. Similarly, in the old tax regime for the individuals below 60 years of age, the exempted limit is income up to 2.5 lakhs, above 60 years of age, and below 80 years, that is senior citizens, income up to 3 lakhs is the exempted limit. So we will remember these things. 2.5 lakhs, 3 lakhs, and 5 lakhs. Next, what is the maximum annual contribution limit under section 80C for tax saving instruments? So we can invest our income into various tax saving instruments and claim the deductions, right? We have certain investments under section 80C like the public provident fund, unit linked insurance plans, tax saving fixed deposit, EPF, NSC, mutual fund, life insurance premium, and many other. That comes under section 80C. And the maximum saving options will be up to rupees 1.5 lakhs under section 80C. All right. So what we can do? We can simply invest in these areas and we can save taxes as well as increase our income. So there are provisions to make investments, savings and expenditure in various avenues. Maximum limit 1.5 lakhs. Then, what are some examples of assets considered short term if held for less than 12 months? All right. So we have the difference between short term capital and the long term capital gains or assets. Basically, capital gain is an appreciation in the value of an asset when I have purchased the asset and when I'm selling the asset. So the time period between them determines whether it is a short term asset or a long term asset. All right. Short term, any period less than 36 months is short term, and any period more than 36 months is the long term. But under the short term also we have certain assets where the applicable period is 12 months or less. So which are these assets? Land and building, equity or preference shares, house property, units of equity oriented mutual funds. So land and building come under the immovable property, right? Immovable property, the applicable period to be considered as short term is 24 months. And for the assets for which the 12 months period is considered is equity or preference shares on a recognized stock exchange, securities listed on a recognized stock exchange, units of UTI, equity oriented mutual fund, zero coupon bonds. So the correct answer is C, 2 and 4. Same assets held for more than 12 months and then sold off will be considered long term capital asset, and immovable property held for 24 months or more will be known as long term capital asset. All right? Yes. So that is the correct answer. Next, what is the role of a bank when it acts as a corporate agent in parabanking? What is parabanking? When third party products are sold by the banks, insurance products, mutual funds, any other thing, right? So, what is the role as a corporate agent? To take on the risk associated with third party products, to distribute the third party financial products like insurance and mutual funds, to provide investment advice on proprietary banking products, to act as a regulatory body for third party financial services. So, when the bank is acting as a corporate agent, they are just acting as an intermediary, right? Banks provide these relevant services through agency arrangement with them. So they act as corporate agent without risk participation, and they earn certain fees on it, right? So the correct answer is option B. They distribute the third party financial products. They do not take on the risk. Advisory will come under the investment management, and they do not act as a regulatory body. Regulatory body will still be RBI or IRDAI or SEBI. So the correct answer is option B. Then, what makes mutual funds a liquid investment? What makes mutual fund a liquid investment? Mutual fund basically is a collective investment. It pools the savings from a number of investors who share a common financial goal. Then the asset management company invests the pool created in various market instruments like shares, debentures, and other securities. And the investors are known as the unit holders. They share a profit or loss in proportion to their investments. So, how does mutual fund provide liquidity? The ability to quickly convert the mutual funds unit into the cash, the guarantee of fixed income from investments, the possibility of obtaining loans against the mutual fund units, mutual funds being traded on stock exchanges like individual shares. So, just like individual shares, mutual funds are convertible into money by the way of sale in the market. So, this is how they offer liquidity. So, the correct answer is 1 and 4. They can be converted into cash and they can be traded on the stock exchange. Other features of mutual fund: it provides economies of scale, it is simple. Investors, they can examine the features. There are various choice of schemes like equity fund is there, fixed income funds is there, money market funds is there. We also get tax benefits by investing in selected schemes like the ELSS under section 80C of the Income Tax Act. All right, next, what is a unique feature about the hybrid schemes and mutual funds? So we have the equity schemes, debt schemes, hybrid schemes, solution oriented schemes, and other schemes as well, right? Debt schemes, which invest in the debt related instruments and ensure regular income. Equity schemes, they invest in the long term capital growth with some income in the large cap, mid cap, or small cap companies. Solution oriented, like retirement fund scheme or children's fund. Hybrid schemes, they invest in equity and debt instruments depending upon the objective of the scheme. So they combine investment in both equity and debt instruments. So this is a unique feature. All right. Next, what is a unique feature of the money back policies in life insurance? So banks, they also participate in the insurance business, which is known as bank assurance, right? So they distribute these life insurance products or non-life insurance or health insurance, general insurance companies. Endowment policies are there, term insurance, money back policies are there, pension plans are there. Apart from the life insurance, banks also distribute the general insurance, asset insurance. So, what is the feature of a money back policy? The policyholder receives a lump sum after a specific term or on death. The policyholder receives a fixed amount at specific intervals during the policy term. The full sum assured is paid only in the event of critical illness. They are most suited for the senior citizens planning for a secure future. So, when we are talking about the money back policies, basically it is an extension of the endowment plan. So, the policy holder receives a fixed amount at specific intervals during the duration of the policy. And in the event of the unfortunate death of the policy holder, the beneficiary will be assured to receive a full sum. All right, so the feature is the policyholder receives a fixed amount during the policy term. If we talk about the endowment policy, a lump sum after a specific time period or on death. Term insurance for the immediate needs of the nominees or the beneficiaries. And pension plan is suited for the senior citizens. So the correct answer is option B. All right, let's move on to the next question. What are the regulatory requirements for banks to act as corporate agents of insurance companies? So there are different ways through which the banks can participate in the insurance business. They can participate with risk participation, but only through a subsidiary or joint venture, right? Banks undertaking insurance, broking, or corporate agency can also be through a subsidiary or joint venture, or they can undertake the broking services departmentally. But here they cannot undertake any risk, they cannot take risk participation. So, what are the regulatory requirements? Banks must have a specific amount of capital reserved for insurance business. Banks must exclusively sell the products of one insurance company. Banks need not obtain prior approval from RBI to act as corporate agents on a fee basis. Banks must follow the IRDAI regulations regarding corporate agency. So, when bank is setting up a subsidiary or joint venture to act as a corporate agent, they should have a net worth not less than 500 crores. The minimum prescribed capital should be maintained. The NPA should not be more than 3%. It should have made a profit in the preceding 3 financial years, and the track record of the subsidiary should be satisfactory. However, when the bank is taking this insurance broker departmentally, there will be a board approved policy. They should take a license from IRDAI. A deposit of rupees 50 lakhs is to be made to IRDAI, right? So these are the things that they need to follow. So the correct answer here is C, 3 and 4. All right. So for taking the corporate agency business departmentally, they need not maintain any specific capital. Only when through a joint venture or subsidiary that specific capital has to be maintained. And departmentally on a fee basis, they need not take RBI's prior approval. All right. But this will be without risk participation. Also, the corporate agents can represent three life insurers, three non-life insurers, and three standalone health insurer. So one only is not a restriction. Apart from this, they can represent two specialized insurance companies, that is the Export Credit Guarantee Corporation and the Agriculture Insurance Corporation of India. These are the important points. Next, what is the coverage scope of the Pradhan Mantri Jeevan Jyoti Bima Yojana? We have two important social security schemes, the Pradhan Mantri Jeevan Jyoti Bima Yojana and the Pradhan Mantri Suraksha Bima Yojana. Both of the schemes, the subscription age limit, the scope of coverage, how the premium is received, all of this, when the scheme will be closed, this is important. So, what is the coverage scope? It covers all individuals regardless of their age and bank account status. It is applicable to individual account holders of participating banks aged between 18 to 50 years. Coverage is provided for death due to any cause. It covers medical expenses in addition to death. So the Pradhan Mantri Jeevan Jyoti Bima Yojana is not for all the age group, but it is only for the account holders of participating banks in the age group of 18 to 50, right? Apart from that, if anyone has multiple bank accounts, they can be eligible to join the scheme through one account only. And benefits rupees 2 lakhs is payable on the members death due to any cause. So the correct answer is 2 and 3, option C. Medical expenses are not covered here. Then, in case there is insufficiency of balance to keep the insurance in force, it will lead to closure of bank account and it will lead to termination of the policy. Next question. What is the age eligibility for the Pradhan Mantri Suraksha Bima Yojana? Suraksha Bima Yojana is an accident insurance scheme. It provides for the accidental death as well as disability cover on account of an accident. So, what is the age limit here? 18 to 50 years, 18 to 70 years, any age as long as the individual has a bank account or above 70 years. So, here in the Pradhan Mantri Suraksha Bima Yojana, all individual bank account holders in the age group of 18 to 70 years in the participating banks will be eligible or entitled to join. Plus, in the case of multiple bank accounts, they can join from one account only. The other account will be closed if they have subscribed from two. Here also, there's the auto debit facility. Insufficiency of funds will lead to termination of the cover. Next, what are the key features of the demat account? Now, when we are talking about the dematerialization, so securities that are held in the physical format can be dematerialized into the electronic form through the depositories. We have two depositories. We have the NSDL and the CDSL, the National Securities Depository Limited and the Central Depository Services Limited. So, transacting securities in the book entry form. What is the role of banks here? Banks act as the depository participant. They hold the demat account. So, what are the features? It allows holding securities in physical form. Securities are fungible. It requires a minimum balance of securities. The account can be frozen for a desired time period. So the securities are held in not a physical form but the electronic form. So first statement is incorrect. Securities in the account are fungible, yes, and it does not require any minimum balance. So the correct answer is D, 2 and 4. So services, opening a demat account, dematerialization, rematerialization into the physical form again, maintain records of holdings in the electronic form, settlement of trades, facilitating transfers of securities. These are fungible, they can be transferred. All right. Freezing of demat accounts for debits, credits, or both is also available. Then other features of the account can be that the process of getting the securities in the electronic form or converting back into the physical form, all of this can be done here. Nomination can be made, then immediate transfer of securities is possible, then holding investments in equity, debt instruments in a single account. Even minors accounts can be opened. All right, so the correct answer is D. And that is all for today. We have covered all the important topics from our module D. These are very important topics, so make sure that you revise all of these topics thoroughly. If you face any doubts, any queries, then you can join us in the JAIIB May 2025 capsule batches that are starting very soon for all your four papers. These will be in English as well as bilingual medium. So you'll get 5 mini marathon sessions per subject, special concept revision sessions, full and module wise mock test, downloadable class notes, and chapter wise notes for all the subjects. This will be the best last minute prep course for your JIB May exam. And the code that you can also join the Super Elite plan where you'll get access to all the batches by using the code HNY and availing 52% off on your subscription. This is the New Year special sale which ends on 15th of April. So avail this benefit, join the Super Elite plan and make your preparation 100%. Also, if you found the video helpful, like the video, share with your other fellow aspirants, and don't forget to subscribe to the channel because these sessions on a daily basis for all your papers are very, very important. Now we are left with only one module, module E, that we will cover very soon. All the other important information you'll get on this YouTube channel itself. So like the video, share the video and subscribe to the channel. I will see you again with other important sessions. Till then, thank you so much. All the best and take care.